serial entrepreneur. I've been in telecommunications pretty much my whole life. I took my degrees at MIT in electrical engineering and the Sloan School, and have been doing technology-related business development my whole life, essentially. I was working with a firm called Boston Consulting Group doing business strategy development for major corporations and in Boston. And I picked up an assignment here in San Diego at General Atomics. General Atomics was a pioneer in the development of high-temperature gas-cooled reactor technology that was inherently safer. It didn't have thermal runaway. There were a lot of things about it were great, but the problem was that existing suppliers like Westinghouse already owned the market. The technology had been funded by the Navy. And so GA, which raised $2 billion from Gulf and Shell, back when that was a lot of money, were unable really to recover their investment. I was sent out to see what could be done, and to be honest, there was not much that could be done. It was subsequently sold for about $30 million to Blue Brothers. But that's how I discovered San Diego. I had left Boston on this typical frigid, icy December day, and I landed here in the garden, and thought that this is a better place than Boston. And so I decided I'm going to find some consulting clients in San Diego in a business area where I might start a venture. And so I foraged around, and I found a company here called Linkabit, which was actually the predecessor company of Qualcomm, and did some consulting for them, and then hired on as their VP strategy. And after a few years with them, left and founded a company called Comstream, about the same time that Erwin Jacobs left and founded Qualcomm. It was a supplier of digital satellite communications equipment for private networks, and the technology worked, but the market did not. This was a period of deregulation. Tariffs collapsed, and the economic incentives for owning your own private network were hugely diminished. And but we had developed viable satellite communications technology, and so instead we pivoted. It's funny, that's become a polite word for a restart. But what we did was we said, satellite communications is superior for broadcast applications, for point-to-multipoint applications, in ways that the two-way network is not competitive with terrestrial lease lines. And so we went into the satellite data broadcasting equipment business in about 1986, 88. And our first big customer was Reuters, who was then the world's largest financial data service provider. They were selling information to their clients using lease lines, using T1 lease lines that rented for about $1,500 a month. And we persuaded them that a direct broadcast satellite networks would make more sense. We demonstrated a prototype, key, and they decided to use the technology. And over the next couple of years, they bought 20,000 earth stations for $3,000 a piece. So they were a $60 million customer. We then saw on the horizon that Hughes DirecTV had launched an $800 million satellite, and we knew they'd need a low-cost TBS receiver solution. So we took the equipment that we developed for Reuters, which had a cost to build about $1,500, and reduced it to a single chip and a TV tuner, and we sold it to them for $65 to DirecTV, and they bought 1.5 million of them. So they were a $100 million customer. And at that point, we sold the company and called it a good ride. But it had been 7 years, not the planned 4 years. And there were costs associated with that I remember. I don't think pivoting, I don't think restarts. I think those are much more costly events than people generally think. I think you need to get it right the first time, or at least before you spend serious money, or you're going to end up with investor fatigue, employee fatigue, and a very low return outcome. Anyway, that was the first of 7 companies that I've been involved in here, 4 of them as founding investor or founding CEO. 4 were successful, 3 were not, and 4 out of 7 is actually, it turns out, quite good odds. None of the venture capital funds talk much about the fact that the most of the businesses, well over half of the businesses that they finance fail. It's closer really to 2 out of 10 or 3 out of 10. That would be the industry norms. I'm mentioning this early in the presentation because what I do want you to think about as I'm speaking is that risk is involved at all steps in venture. The risk can be managed, but that it's not avoidable. Many people agree that there's risk of the startup failing, but they think that's the other guy's company, not their company. And you need to get past that and position yourself for not just the spectacular outcome, but for survival. So we're going to talk here about financing a new venture. You have a handout that's highly detailed. I'm not going to read every line on it, but it's a takeaway for you of information that I think you as prospective entrepreneurs should have hand. And I encourage you just to interrupt me with questions anytime, and we'll also have Q&A at the end. So it's your call. So this is what we'll talk about today. The first 4 topics here: need for external financing, sources of equity and debt, equity versus debt, and stages of equity investment, are basically a primer of the sources of capital that are available to a startup company. We'll then talk a little bit about the key characteristics to attract funding, a large portion of which has already been talked about today. Then we'll talk about some seriously interesting topics regarding the ownership of the company, how the equity gets allocated among the founders of the company, the shareholdings that founders and management can expect in the venture as compared to the shareholdings that venture capital investors can expect in the company. Then we'll talk a little bit about deal terms and then some thoughts about managing risk.
Alex, are you getting blinded by that?
Oh no, it's hitting the door.
Okay.
Oh, the laser's reflecting and I was just like, ooh.
I see. Well, I don't want to do that.
If you just go up, just make sure you go up, then it'll be above everybody's eye line.
The red one doesn't work with this screen for some reason.
Right.
This is a bright one. So, the need for external financing. Do you need it? Why do you need it? Well, first, and this is the one we all understand, is you're going to use it to fund the launch of an exciting new enterprise. Number one use is hiring a founding team of great employees, and I emphasize that this founding team of 3 people, 4, 5 people, must be truly great. Those are the people you want as partners, nothing less. If you can't round up great inventors, don't do the venture. It means it's not good enough. You have to come up with a sufficiently good idea that you can attract truly great people as your partners and as your investors and as your directors. Obviously, you need to fund aggressive market-focused product development. You heard this market-focused issue raised repeatedly today. It's vital. Second, acquire the necessary return. Second, fund the market-focused product development. Thanks. Acquire the necessary R&D, production equipment, facilities, fund marketing and sales, go to market, and then continue to fund initial operating losses. It's quite ordinary to have operating losses during the first 2, 3, 4, 5 years of a company, but it obviously requires money from somewhere else, money from third parties. What's surprising to a lot of people, though, is that you subsequently then need to fund even profitable product growth. Profits alone are not sufficient to provide the capital that you need to grow and run a business. For example, $1 of sales, say 50 cents to $1 of sales requires about $1 in assets. So what that means is that you have a 20% return on sales. That means you've got a 20% return on assets. That's the growth rate of the company based on your actual profitability. Whereas your early stage growth rates themselves are typically in the 50 to 100% rate. Saving profits doesn't allow you to purchase assets in sufficient quantity to grow the business at 100% growth rates, which are what we all want to see happen when it's an early stage small venture. So 2 reasons for external financing. One is just to get the plane off the ground. The second is, if you're doing well and growing quickly, you're going to need to acquire assets and to enable the venture to grow.
Franz, there's a question up front.
Can I ask you, so you said not even to bother unless you have a team of like 3 to 5 people you consider to be great. What roles, like what are the 3 to 5 roles that need to be filled? So you have an initial idea, and So for example, maybe someone who's can deal with the finance, and if you don't know anyone who's
For people like yourselves, for high technology experts who would like to see a venture, the best first step in terms of partners is a person who has startup experience, an experienced telecom entrepreneur, or a person who has had business responsibilities like senior product management, where they have day-to-day experience with developing, fielding, supporting customers, and so forth. And by the way, it's very hard to raise financing without a CEO that has already been through a startup. And I know there's a catch-22 thing there, but you just have to slug your way through on that one. To me, the ideal team can be as small as 2. Most of my startups have involved 2 or 3 people at the outset, and the 2 are obviously there's one technology leader and there's one management person. That's the core team that can get the ship off the ground. But you will probably know, if the founding CEO will probably know somebody who's very good in marketing and sales, and the founding CTO will probably know somebody who is very good in engineering and hands-on technology development, and that's the core team, technology and business development skills. So here are some of the primary sources of equity and debt capital, and we're focusing on 3 of the most visible. There are other smaller ways, but this is where 80% of the deals get done. When you first launch the venture, founders, family, and friends can be a very tempting target to raise money. It's something that you want to do with great caution because there is high risk in any startup venture typically, and you want to be sure that you're willing to expose your family and friends to that risk. And if you do, there should be some substantial payoff available to them should the venture succeed. So you want to be giving them terms that are as good as you're going to give the institutional venture capitalist down the road. The second category of investor, and I'm more comfortable with these than with founders and family and friends, is angel investors. These are individuals who purchase equity, purchase ownership in startups, and they ordinarily have some substantial level of experience and expertise in the business of starting funding high-tech companies. They can bring you a great deal of experience. They can be very well connected, and they are the people that you often need to turn to in advance of going to a true institutional venture capital investor. San Diego and Southern California generally, and for that matter the Bay Area, has a number of different angel investment groups, and it's good for you just to, in the long term, get to know these organizations, attend some of their meetings, meet some of the people, get a sense of the culture as it exists out there. The typical angel investment size might be in the range of $50,000 to $1 million. The institutional VC could be more like $1 million to $10 million or even hundreds of millions. The institutional VCs give funding to startups in an early stage in return for equity in the venture. That is to say, they give you money, you give them shares in the venture. And they specialize in high-risk, high-return portfolios. And by high risk, I mean 50% chance of failure, return expectations on the successful ventures that are described not in percentage terms, but as multiples, like 10 times their investment or 50 times their investment. That's their business, is taking on high levels of risk and seeking to raise very, very large returns on large investments. There's also a great deal of capital available within corporations using their own internal technology and business development, and that's not what we're talking about. Well, that's been described earlier today in the last panel. Bottom of the list is bank loans, equipment leases, and other kinds of debt.
Excuse me.
Franz, there's another question here.
So between angel investors and institution, it's just the level, the size of the investors, the investment?
Angels are acting as individuals. Venture capital institutions are usually organized in a fund. The VC raises a fund from institutions like pension plans, insurance companies, wealthy individuals, and its job is to take that fund and over a period of 7 years or so, 8 years or so, invest the money and then earn returns on the investment. The angel is looking for a shorter term, active involvement. The angel will provide you with, say, $1 million or $2 million, and at that point, they truly are your angel, and you're going to work very closely with them as as you should, and you're gonna respect them and support them, and they're gonna respect and support you. But they're gonna have a very similar motivation to yours, which is moving on to the institutional venture capital investment. They usually will be given rights, by the way, to invest pro rata, invest such that they can maintain their percentage ownership in the venture when and as you do obtain venture capital financings.
So if these are just, like, wealthy individuals, where do you go about finding them?
Tech Coast Angels, just do a search on angel venture capital investors, and you'll see.
Every major city has at least one or more organizations now.
At least.
Desert Angels in Tucson, there's a group up in Phoenix, I can't remember what they're called, but yeah, no, they're there.
And they do work, they form syndicates with other angel investors. That's a good portion of their participating in organizations like Tech Coast Angels, is that perhaps they'll like to put in $200,000 or $300,000 apiece across 4 or 5 of them. Here's $1 million financing. So they have other individual angels that they know with, that they have invested with and are comfortable working with, and so forth. By the way, there's a ton of sources of funding out there, as you'll see. There's no shortage of that. If you've got the right business opportunity, you've got the right team and the right plan, you can get a financing. Equity versus debt capital. I'll make a distinction here. With equity, as I said a moment ago, startups give shares to investors in return for their money. The investor becomes a partial owner in the startup. The investor has no guarantee that the venture will succeed, that it's entirely at risk, and therefore they expect very high investment returns. Any equity investor in a high-tech startup is looking for returns, again, that are measured in terms of multiples, not percentages. With debt, you have a lender who gives you money, and the company undertakes a contractual obligation that says you will repay the debt at a certain point in time with a certain interest rate and certain other associated premiums, and that's that. And it's perceived as, it can be perceived at low risk when it's not really the case. Usually if before a bank is going to loan you some money, you probably have to have personal investment in the venture, and they probably will ask you to guarantee any loans. So although debt typically returns low percentage returns on investment, that's not the case in terms of an early company. In an early stage company, they're probably going to look to you or their lender to assume the risk. So
For example, your house, I
I'm
guess,
sorry?
is your house is often an example, right?
Yeah, yeah,
They're going to have you take out a second mortgage on your house, as collateral.
Right.
And see.
Yeah, and the bank knows it can get paid because you have a house.
Yeah.
And, but yeah, because equity investments in early stages of companies are costly in terms of the amount of capital they have to give up to bring the money in, that can be seen as an attractive low-rate alternative. But it's usually only available with hooks that find their way back to you or some other third-party guarantor that will be paid. So the stages of investment, as I say, seed and angel are the first. They're the first in the earliest stages. This is sometimes called Series AA or pre-A rounds. Oftentimes not sufficiently far along that you could bring in an institutional VC. Includes funds from friends and family. Again, ultra-high risk, very high prospective rewards. Funding amounts from seed and angel, tens of thousands to $1 million. Simple deal structure, as I'll describe later, the actual legal agreement that accompanies a venture financing, is a very, very elaborate, carefully laid out, and challenging set of terms to reach. An alternative to that, rather than go through all of the terms and conditions associated with an equity financing, which I'm going to describe, is you simply arrange for something called convertible debt, where your investor loans you the money, and that amount he loans is converted into an equity investment in the venture at the time you bring in the next subsequent financing. So it can be a pretty simple piece of paper then. It simply says that I'm going to borrow from you $50,000, and you're actually not going to be repaid that amount. What you're gonna get to do is to have that $50,000 converted into Series A shares when and if you do obtain this venture capital round of financing. So it's a pretty simple thing as compared to what you see in terms of venture capital rounds. So VC funds get involved with Series A and following, and I don't know the exact numbers, but Series B, C, D are the preponderance of the funds that are raised by a given venture capital fund. That is to say, second and third and fourth stage investments are more where they are more comfortable. The A round is probably the toughest round for a company to raise. The companies in which they invest tend to be more mature, but not necessarily profitable. The valuations are much higher, funding amounts tens of millions, and they're accompanied by complex deal structures.
Just to be clear, you mentioned that, any of the investors also know that this is that it may be high risk. So what happens if you're unable to pay back their investments?
They don't get it. It's gone.
So they know that.
Yeah, and in return, they should have the chance to earn 3 times or 5 times what they put in.
Okay.
But they should be aware that there's at least a 50% chance that this is gone money.
And so when they even, like when you mentioned taking on debt, like you said something about having like a mortgage or something, what is that where does that fall in? Like when are you responsible for paying it back?
Are we talking about equity or debt?
Yeah, I just got.
If we talk about debt, that's where you personally guarantee the debt.
Okay, so you're saying if you personally borrowed money
And
from somebody.
associated with your personal
opposed
guarantee
to-
is that
Okay.
if you're personally unable to write a check, you have to start selling things or
Mhm.
borrowing again. So it's not to be taken lightly.
So, about the debt convertible to equity, so what is this different than just the investor, for the equity investment?
Why not just make a direct equity investment?
Yeah.
Yeah.
Well, if you don't get the next series of funding, it doesn't convert, right? Then it's just a debt.
Right. Well, the other thing too is that it's very difficult to determine the prospective value of a venture at this very early stage, and it can be a real waste of time to try to determine exactly what this venture is going to be worth and the terms under which you will achieve liquidity on the investment when it's just people with an idea. And so much simpler at that point to simply say, all right, you're gonna loan me the money, and when and if I get a financing, you're gonna get to participate. Your loan will convert to equity, and the valuation of the company at that point in time will have been negotiated by a large and sophisticated group. Convertible debt is just a simple way to put money in, not knowing exactly the terms that will take place when you obtain an equity financing. And I'll show you later typical VC deal terms, and you'll see what I mean. They're extensive.
But it's still debt until it converts.
It is debt.
But it's unsecured debt?
It's
How does that work?
unsecured. Yeah, it's debt that's going to turn into equity. That's what the person who makes you the loan has determined, or should understand.
But if you go under before that first round, what happens?
It's gone. You made a loan to a company that didn't.
Well, you're then a creditor to that. You're a
creditor.
Right, you'll go through that creditor process.
Okay.
You can set up, they could have sort of a lien on a large piece of equipment, maybe that's why you need it. It can be complicated,
Yeah.
just.
But like for debt, when you get a debt, then you have to pay back, no
Right.
matter what and what circumstances.
Well, no, so here it's the company, right, that has the debt, not you personally. So the companies can go bankrupt. There's a,
Right.
legal process that processes its way through the system. So.
But then this is different than the debt like a bank? Because you can get a debt from a
bank that
person
I
as well.
described earlier is debt where you personally have guaranteed, where some party has guaranteed the loan will be repaid.
Oh, I see. But in this case, it will be the company.
That's failing to pay the debt, pay back the debt because the company has failed.
And so in the beginning, the contract or whatever type of agreement is made such that they say that they invest this initial amount and that's the exact terms of how much of the company they'll own will be figured out later?
That's right.
Yeah,
That's a
okay.
good, very good summary.
Okay.
And this is a good point that was brought up there, that, you know, keep everything under the company, in the company name, if you can, right? Don't go signing things with your own money in your house and stuff like that unless you're really desperate. People do that. I wouldn't advise it, but the company can go bankrupt, that's fine, right? And then
Still go on.
you move, yeah, you move on.
Yeah,
So-
move on. But you want to be able to move on without repaying a loan that you shouldn't have taken in the first place.
Yeah, don't get yourself into a big mess.
And again, you know, I'm not saying don't take risks as you go forward. I'm a risk taker, I'm a big believer in it. But just know that you're doing it, know the extent of the exposure that you're taking on, minimize it to the extent that you can.
Yeah, you gotta understand your downside.
And where would SBIRs fit into this?
SBIRs are a great additional source of capital for an early stage company. There's no problems with them. You're not personally guaranteeing SBIR loans. I didn't attempt to name all the different sources of capital that are out there, but that's a good addition. SBIRs, especially for people like you who are accomplished research scientists and know the possible sources of SBIR funding, it's not bad. But it's not $1 million kinds of numbers. It's 50,000, 500,000, something in that range. Material. Which one? Convertible loan agreement?
okay,
Yeah,
convertible
it's called a convertible loan agreement.
So Amanda, the difference is basically you're agreeing that you're not gonna get any worse terms than when they go with a large institutional investor. So that's sort of your guarantee,
Yeah.
right?
Is
So
that what?
that your terms aren't gonna be any worse than what they've agreed to with the large company. Okay? So that's kind of your backstop, is that, you know, if the company gives you $1 million, and just to make the math easy, I gave you 100,000, right? I'll get, 10 to 1. You might make it out that mine's because I gave it to you early, it's going to be twice what you get. The VCs will then kick you for that,
So
but
in other words, your benefits from investing in the company early on will be greater than anyone's
that's
investment.
that's a
At least
negotiation
as
point.
equal to.
Yeah, equal
Greater
to,
than
no
equal
worse
to.
than the people that invest
Okay.
later. Okay.
You can sometimes write a deal for yourself that says you're going to get much more in equity than you paid for.
Yeah.
And it's right there and it's a contract. But the problem is that when you sit down with the venture capitalist who says, we've decided we want to invest, he's going to say, but we don't want to see that 2x or 3x
Right.
payback.
Yeah.
And you then say, but I have this agreement.
Yeah.
And they say, well, we don't care.
Right. This guy stood by me for 2 years through thick and thin. Yeah. We're new money. We don't really care about your old money.
And,
Good see. Yeah.
I mean, and this is more generally, you don't want to be looking for deal terms that are way outside of the norms in terms of valuation, in terms of deal complexity, in terms of repayment provisions. If you come up with a complex, oftentimes messed up capital structure, and then try to take it to market, the first thing that's going to happen is people are going to want you to revise the whole thing to look like a conventional early stage venture capital financing or early stage angel investor financing. Just because you can talk somebody into a weird and excessively profitable deal for yourself doesn't mean that you're going to be able to sustain that. The new investors are going to be in a position that no, that was then, this is now.
We're going to talk about dilution
Yes.
later.
Yeah.
Conventional here, in my experience, is 20 to 50% kicker for the people. Was that in line with?
Yeah, something like that. But not 2x or 3x. And and generally, you don't expect your returns, your rewards, to come from some kind of tricky deal structure that's negotiated. A plain vanilla financing is all you need. You don't need to stretch the envelope in terms of what are reasonable terms. Something where both parties feel the outcome that was reached, the evaluation that was reached, is fair and amicable and reasonable is really, really important. Because you're going to be sitting down with these investors, your angel investors, your venture capital investors, for the next 4 to 7 years. And there's going to be a lot of things that come up where mutual agreement is required. And again, staying with the norms and keeping with a sense of partnership from day one is how you're going to get the get it done.
You don't wanna give your age
So
on a
characteristics
veto
to
power.
attract venture capital funding. I think this was discussed already to a certain extent this morning, but what I wanted to add is that you want to target a very large opportunity. Why not? It's just as much work, or nearly as much work, to create a $10 million venture or to invest in a $10 million opportunity than it is to invest in a $100 million opportunity. The deal that comes out as a $100 million opportunity is unlikely to pay you 10 times as much as the $10 million opportunity. So, again, you don't want to become enamored with a really cute gadget or device that you've developed for which there is not a large market. You're missing half the equation if you don't have that. Limit your choice, limit your targets to big markets. By that I mean markets that are measured in hundreds of millions or billions of dollars. There's no reason not to do that, and that's how you earn really massive returns. And that's how you get financed, is first show that there is a large population with an unserved need, a large population of customers within that population. By the way, it's not a good business to be in when you have one customer or two customers. It gives them enormous pricing power over you. Much better to have a big market and a large number of prospective customers in that market. And then a proven solution, and we spoke earlier today about how powerful a demonstration, how important a demonstration can be, and I couldn't overemphasize that. If you have one successful product demo and you have one substantial customer that's willing to say, we'd like to buy that, or we'll give it a try, that makes obtaining your financing twice as easy. It's a huge milestone, and if you see the way to come up with a working prototype and come up with a prospective first customer, you're halfway there. So, and then last, a strong and enduring advantage over all potential competitors. Sustainable competitive advantage is again, a very necessary attribute with a venture if you're going to bring in the monies that you need. Then there needs to be then an exceedingly high potential return on that venture capital investment. As I said earlier, VCs have learned that most new ventures fail to meet projections or even survive. These are all private partnerships, so there's not public records of what their success rate has been. But part of the reason the main reason it's not public is that it's not a very pretty picture. The success rate, my estimate, I don't know the exact number, but my estimate would be maybe 20% of the ventures. What do you gentlemen think?
Yeah, 20% may be on the high end
Yeah.
even sometimes. You know, it depends on the technology base you're in and things like that. Yeah, I'd say maybe 20% maybe get near your 10x, maybe 10% sort of wash out. They maybe get their money back or some substantial fraction. It gets sold, but you know, not nearly 10x. Yeah, 70%
Yeah.
or legs up. Yeah, it's just bad.
So
Overall average is more like 6%.
Yeah.
I said, I'm trying to be optimistic here. I say that half might survive. So I asked for third-party information there, and we're talking more about 1 in 10. 1 in 10.
Well, it was the failures, the Walking Dead, and the
Right.
successes, right?
Yeah.
There are cruel failures, there are kind failures. Cruel ones tend to take a long time to work themselves through. In the venture capital world, they're called zombies, they're called Walking Dead. You know, the VC is reporting to his investors. VC himself, has to go raise money. He gets it from insurance companies, pension funds, and other individuals, and they want to know how things are going. What have you invested in? How's that deal going? And it's the last thing you want to tell him or her that, well, looks like 4 of the 5 are going to tank. You tend not to even want to talk about that. And by the way, the venture guy is taking they get paid 2 ways. They get if their investments are highly successful and the fund makes a lot of money, the VC investor typically gets 20% of the gains for the fund. There's some star funds that get 30%, some not so good that get 10%, but it's called their carried interest. But they also charge a management fee. Management fee on maybe 2% of the funds that they raise. And that fee is used to pay the rent, keep the lights on, and pay what can be pretty big salaries. Do the arithmetic, these are $100 million to $500 million funds. 1% is a lot of money. And so there's also a tendency on the part of VCs not to report failures or zombies, because there goes the management fee. This doesn't get talked about much, but this is what happens, is there are obligations, there are reasons to try to mask the inherent risk that's endemic to this sector. So they're looking for home run outcomes, and given the 1 in 10 success rate, you can understand that may not be so unreasonable on their part. So let's talk about the allocation of the equity. Who gets the ownership in the company? This is very important. Ownership in a startup is shared among the founders, the founding team, the management team, and the investors. And they typically issue 2 classes of stock, one called common stock, the other called preferred stock. Founders and the management team earn common and options. These are common shares that they own, they're given at the time the venture is formed, or these are rights to purchase shares when and as they wish to. They get common and options to buy common shares, and they get that in return for their energy and their ideas over a period of years. On the other hand, investors purchase preferred stock in exchange for their money. So you, the entrepreneur, put in your energy, put in your time, put in your best efforts, bring your experience, and in return you earn shares in the company. From the point of view of the investor, he paid you now, or she paid you now, and so nothing further is really obligated from them. Now, a good investor knows that they're going to have to work hard to support the company and manage the deal, and they're not seeking to not to provide support going forward. But the terms of the deal is how many people owe the company 4 or 5 years. Preferred own the equity that they purchased outright. So what's the difference between preferred and common from the point of view of you, the entrepreneur? Well, in the event of sale of the company, preferred shareholders usually are paid back their investment first. Before anyone else gets any money, the preferred shareholder gets his money back, or the deal could say some multiple of the money back. And then common shareholders get what's left, divided pro rata among the common shareholders. In the case of an IPO, in the case of an IPO, the preferred shares ordinarily convert to common, and anyone shares pro rata in the proceeds. There's a subset of preferred shares called participating preferred, in which case the preferred investor gets their money back, plus any interest, plus they then participate in the remaining funds. They and the common shareholders divide up the common shares among themselves, prorated based on their investment. As I say, that's called participating preferred. It's to be avoided, but it happens all the time. Any questions on this? So let's talk about the shareholders of founders and management. The founders are you guys. So at the inception of a startup, and this is prior to any venture capital investment, the founders, which could be 2 people to 5 people, purchase 100% of the shares in the company. And you do it at some nominally low value, $100, $400, nothing, because the venture isn't worth anything. It exists, there's a corporation that's been structured, and they're about to be shareholders, but the valuation on the company at that point is based on prospective outcomes that haven't yet even been defined. So it's very easy for people like yourself, with the assistance of a good securities attorney, and then we'll talk a little more about that. You definitely don't want to try to, this is not do it yourself, do it at home. You need a professional guidance on this. But the stages are that first you establish a corporation, and then someone, i.e. you, gets to own that corporation by buying all the shares for a nominal price. Then, so what that means, we're a two-person founder team. I said earlier, how about a CEO and a CTO? That is a critical mass to get a deal started. That means each of you owns half the venture. Now, it's half of something that doesn't have any guaranteed value, but it's half the venture. And there's no other way to get half the venture. Being a founder is the right way to go. Subsequent to the company being founded, the founders next reserve a pool of additional common stock. They say, okay, we sold 100,000 shares, and we're going to take another 20,000 shares, and we're going to reserve them for new employees that are going to join the company. And those employees are going to receive stock options in the company, options to purchase the stock at a low valuation. What are the typical options for management team members? These vary widely, by the way. For the CEO, the Chief Executive Officer, or the President and CEO, usually the options are in the range of 5 to 10%. If there's a Chief Operating Officer who reports to the CEO, 2 to 4, CTO, 2 to 4, Chief Financial Officer, 1 to 2, VP Engineering, 0.5 to 1.5, Director of 0.5 to 0.1, and then all others in the range of 5 to 10%. So the average percent of ownership of the deal of the company that goes to the option holders is 24% in total. But you, the founder, can also be the CEO or the president or the CTO. So you double dip. You first get your half share in the venture, and then you get the option percentages that would go to the position you assume within the company. And if the average shares, 24% of the venture total that go into the option pool, the average total that goes to the founding CEO is 47%, and CTO 43% of the company. These are huge chunks. If you look at the CEO, he's there at 5 to 10, and the COO 2 to 4, and CTO 2 to 4. But these two people that were smart enough to found the venture are sitting on 47% and 43% ownership. When I tell this story, I feel like I'm telling a secret, because entrepreneurs don't all universally understand the value of being a founder. It's hugely greater than being the second group to join the company.
I'm confused how you went from, so half to then 5 and then 47.
If we take if this takes 100 and grow, there's a couple things going on here. We start out with 100, let's call it 100 shares in the company.
Yeah.
Then we issue 20 new shares for the option pool.
Okay, so
So
now
now
that's
you're at 80%, 100% went to 80%. Then we add back in the 7%, I'm using the average, 7% for the CEO, 2 to 4% for the CTO, that's how you drive to 47.
So you're saying, like, if you have 100 shares and then you go up to 120 shares, but of those 20 shares, they have 5% of those.
Yes.
They have,
Yeah.
yes.
7%.
Right, and you'll basically earn those maybe over some period of years.
Right.
So you basically, if you'd hired somebody or it's you sort of make that same deal where they're going to get 1% a year for 4 years, just as an example.
This is the deal, the typical deal.
Right.
That describes the stock option pool. Almost all high-tech companies have a stock option pool as part of the capital structure of the business. There's just this big overlooked fact that you're going to have a hugely greater percentage of the company through being a founder than any other way.
Well, I was just going to point out that there's a big assumption here, which is that these percentages are basically post-funding. So if you're starting a company with zero money and you want to attract a bunch of people like this, it's a much higher number than this thing.
Well,
Could be,
you
yeah,
know,
it
my
depends.
experience has been
Really?
different. That I am amazed at what can be negotiated in terms of the reward for being a founder. It's disproportionate. It's not fair. But,
No, I'm saying, the founder, yeah, but I mean, in terms of like, say, a VP of engineering,
Yeah.
if you want to get a VP of engineering and not pay him any money, I don't think you would attract someone at 1.5%.
That's the CTO. That's the I agree completely.
Yeah, that's what I'm saying,
Yeah.
that there's when you get money, then you can do this.
Right, I think it's salary plus this, I agree with you.
Yeah.
Yeah, if you're
Yeah.
asking people to work for free, they typically are gonna demand
Oh,
more
yeah.
equity.
No, the salary for sure.
Yeah.
The-
Yeah.
The
Yeah.
concept of starting a company with sweat equity and not taking salaries
Yeah.
is old. If you have a worthwhile venture, it can be financed, and you can have funds advanced to you before there's a profitable business created. That's just how good it is out there.
Yeah.
Is that it's possible to start a company and get paid from day one, or at least 6 months, day one plus 6 months. So the shareholdings of the venture capital investors, it's funny that PowerPoint put this in fine print. So, founders and management present the opportunity to targeted VCs, citing those key characteristics we described earlier. And by the way, experienced securities attorney or experienced angel investor is going to be able to guide you and help understand that here's a list of venture capital firms that do optical component deals. Here's a list of venture capital firms that do social networking deals. Most VC funds, not all, but many of them tend to have specific areas of expertise where they've made numerous prior investments. So you want to target those people that already know what wave division multiplexer is. There's no reason not to go to those firms who have made it clear by their investment history, that's all public information, that they know, understand your technology, or they invest in your sector. So those are the folks you want to go to. Then begins a process where after you make your pitch to VCs, they go through what's called a due diligence process. And this is a methodical process where they attempt to confirm the size of the available market. They attempt to confirm certain customers will be available. They'll attempt to confirm that you are a distinguished optical networking scientist. They'll do basic homework on the deal. And again, this all can be conducted in very good spirit, in a very good spirited mode. It's not a question of looking for bad news. It's just confirming what you think is a very attractive value proposition. And they can do this pretty quickly. Many people might say, as a rule of thumb, allow a year to get a substantial venture capital financing done. If you've got the right proposition, if you've got a proprietary technology and you have a customer in an interesting market, you can get a financing done in a matter of weeks. My last company, Raceband, we had one meeting with Sequoia Capital, and they called an hour after the meeting and said, we want to become a shareholder. And that was that. They are looking for good opportunities. They're looking for big opportunities. And if you present that, if you have a needed technology that has some competitive advantage and you've got a customer or two that says we'll do business with them, you can get a VC financing done very quickly. But if you try to do it without those basic boxes checked, without covering those, it can be a long march. And it can be a year, it can be longer than a year. But it's incorrect to assume that you can't do venture capital financing fairly quickly. By the way, it's tougher when you're an optical component startup that has to get designed into a big box, that has to get a carrier to sign off on. It's harder to do that than it is to launch a social networking site, and that's not fair, but that's just the way it is. So here's where it can get challenging. The VCs make an estimate of the prospective outcome valuation of the startup. What do we think it can grow to in terms of revenues? How profitable can it be? What kind of a value can we expect from this company 3 years from now or 5 years from now? And then they use their expected rates of return, which can be as high as 100%, but you can probably see people that will do a deal in the 40 to 50% rate of return. And they take that ultimate outcome valuation and they discount it down by the required rate of return on investment, and that takes you to a starting valuation on the company. And that's where there can be a lot of disagreement, because at this point, you really believe in your venture, and you believe in your technology, and you talk to customers, and you're sure it's going to be a great outcome. And the VC, on the other hand, doesn't have all that information. He just got tanked in 2 other deals, and he's not in the mood to discount or compromise. And these discussions can rapidly get heated, and it's to be avoided if it can be. then one point here is, after you get this first round of financing, what about the second and third round? How does that get value? By bringing in a new investor. You want to have a qualified new investor to bring to the syndicate who doesn't have any money in already, and so hopefully has a pretty clear, is pretty open to what the valuations might be. And that person prices the deal. Now, do they do it in cooperation with the other syndicate investors? Of course. These people are all friends, their kids play soccer together, they have a community. And and out of that community, you can select your investor who provides your B round, your C round, and D round. Usually the investor who invested in the A round will have the rights to participate in the B, C, D rounds, typically on a pro rata basis. They can put in money to the as necessary so that they maintain a percentage ownership in the company. So, as I mentioned earlier, you want to try to keep everything fair and happy early on, even through this difficult valuation process, because these are all the other terms that typically encumber. It's supposed to enhance the venture capital agreement. You've got, obviously you have the so-called liquidation preference. The preferred shareholder gets paid back first. Participating preferred gets paid back pro rata, gets its investment back, then pro rata share of any additional gains. Anti-dilution protection, which attempts to protect existing investors from dilution that occurs if the company's progress is not what it hoped to be, and the valuation should be, next financing is obtained at a lower valuation. Those people who have these anti-dilution protections by virtue in their prior investment in the company get to reprice their investment. They get to see additional shares introduced to them either at that time or when and if the company goes public or is acquired. And there's, unfortunately, sometimes they include so-called full ratchet term. And what that means is that if one share is sold at a lower valuation,